Good morning, Wealth Warriors. It is Brent Harding in the house. How is everybody doing this morning? I have to tell you, it is exciting. We're talking about a subject matter that typically you wouldn't get too excited about. In fact, if anything, most people are trying to figure out a way to avoid it. And yet, that's not what we want you to do. So get ready. For those of us that have not been have not watched the broadcast before, or really don't know what the genesis of Wealth Warriors is all about, let me bring it into focus for you. How about that? Wealth Warriors, we are people that are fighting for our family's financial future. In fact, a majority of us are first generation wealth babies. And like I always, when we start the broadcast, I always like to say, go on up to the exclusive elusive Wealth Warriors Facebook site and let us know you're here and that you're a first generation wealth baby. So hashtag I'm a first generation wealth baby, because that's what we are. And what's our mission? Our mission is to create financial wealth, not only for ourselves, but for generation after generation after generation. And if you're the first generation, then it begins with you. And so what we're doing over the next 12 months, which actually started in April, is we're studying wealth. We're studying the components of wealth. There are 12 principles of wealth. And I tell you, when we get to principle 12, 11 and 12, you are just going to marvel. In fact, you might even laugh when you get there. But by then, we anticipate that you will purchase real estate, that your credit will be pristine, that you will be able to access streams of income as a result of what we are doing today. And it's pretty daggone powerful. So without further ado, I want to share with you, during the month of April, we started off and we talked about real estate as a wealth vehicle. And that's actually number 3. And then we went to number 1, and number 1 is about credit. And now we're at number 4. That's right, number 4. And that is insurance. You know, oftentimes people think of insurance and we're only thinking of life. We're thinking of health. We're thinking of vehicle. And more often than not, we're thinking of the first 2. But there are other pieces. There are other instruments of insurance that we can bring to the table that are investment tools. So we're going to talk about those type of activities. We will get back to life and health for a certainty, but what we do want to make sure we talk about is the life insurance that has a component of wealth building, the instruments that have wealth in them that you can utilize. Because I will tell you something, wealthy people have insurance. I know that sounds like, but wealthy people have insurance, and they do invest insurance. They invest insurance companies, they invest insurance instruments. And we have an SME, a subject matter expert, here with us this morning that's going to talk about wealth. What I appreciate about Jay Small is that he's young, and that he's serious, and that he is focused, and that he has integrity in the things that he does. I have the privilege of working with his grandmother in another wealth building venture. And so we have all spectrums of the age bracket, and that jazzes me to no end. We have from the millenniums to the baby boomers. So again, you're on the Wealth Warrior broadcast. Now, let me share with you one other piece, and that is wealth commitment. The folks that are watching, that are involved, are committed. We are committed to producing wealth. And there's nothing wrong with that. In fact, the country, the United States of America, was predicated on people leaving and coming here. Why? Because they were looking for a better way. They were looking for a better life, and they weren't finding it in the country that they were in. And so they took the journey across the ocean, whether it was by plane, train, but not by train, okay, by plane or by water, they got here, and with the view towards having a better life. So with that being said, we're going to get the broadcast started this morning. And what are we talking about? We're talking about the fact that insurance can be sexy. Because I got to tell you, when you're making money, that is sexy. When you've got residual income coming into your house, that is sexy. So can I say insurance is sexy? Yes, I can. Without further ado, let me bring to the forefront a very interesting young man. Interesting because at his age, he has done a wealth of around creating and building for himself and sharing that with others. So let me introduce you to our insurance agent, who happens to work with Liberty. Oh, let me get that right. No, I'm going to let him tell you what he works for because I just had a brain burp, but that's okay. Let me introduce you to Jay Small. Jay Small, are you there?
Yeah, I am here. Thank you very much, Brent. So yeah, just to branch off that introduction, I really appreciate the opportunity to be here today. I'm very excited for this discussion that we're going to have because we're going to share a lot of valuable information for everybody listening, no matter what age you are. So to go back, I'm with Liberty Mutual Insurance.
Thank you. I'm so glad you said that because I was having a brain burp there. Go right ahead.
No problem at all. No problem at all. But you know, the things we're going to talk about today aren't necessarily just Liberty Mutual things. They're general insurance principles, and they're things that people should be talking to their insurance agent about, regardless of who you have for an insurance company. You know, these are questions you might not have thought to ask your agent before, but these are things that your agent would probably be more than happy to talk about with you. And if they're not willing to talk about these things with you, then maybe that's a sign that you need a new insurance agent. But just to go back to a little bit about my background, I actually graduated from Worcester Polytechnic Institute in 2013. All throughout that time, I was working in banking. So I've been around the financial services industry for the last 6 or 7 years. So I have a lot of knowledge with banking products and some of those things. And then being in the insurance world, you can see the differences and some of the overlaps. And really, you can see where some people may be putting their money into the wrong types of things, and just tying up money that shouldn't be tied up and thinking that they're doing the right thing when they're really not. So hopefully we can clarify some of those misnomers today.
Excellent. You just said something very interesting. You said putting their money in the wrong thing or tying their money up in the wrong thing. What did you mean by that?
Specifically, I was thinking about CDs. You know, I'm sure a lot of people think of CDs as a great way to save money, but if you've seen the rates lately, I mean, you're lucky if you can find a 1% rate of return on a CD right now, and that's probably tying your money up for at least 5 to 10 years. You know, and it's going to be some sort of promotional rate. So some of the products we're going to talk about today, putting your money there instead, you know, it's still safe. You're still guaranteed your principal, but you can actually see a lot more growth, you know, when we start to talk about things like annuities and some certain whole life products that build cash values and things like that. So that's what I had in mind when I mentioned that.
I appreciate that. Thank you very much. I will share with our listening audience, our viewing audience, that one of the reasons that insurance came up for me, and it was so prominent, and we're going to talk about homeowners insurance probably at another time, but I wanted to at least see you with why we started talking about insurance and why it's one of the 12 principles. Here we go. All of you know, at one time I owned a mortgage brokering firm. I actually owned that mortgage brokering firm for 10 years and had a young lady come in who owned a 3-family piece of property. And much to my shock, the young lady did not, in fact, have insurance on her property. And I remember thinking, oh my goodness, this is a catastrophe waiting to happen. And sure enough, we are in the refinance process and a slip and fall occurs. Slip and fall, somebody allegedly slipped and fell, and it was a tenant. And I said to her, how is it that you own the property? She said, well, as soon as, you know, I was so glad that I owned the property. I got the title to the property, and I figured I didn't have to pay for insurance anymore. Well, guess what? What was the outcome of the story? The outcome of the story was, while she owned the property, there was a lien on the property. The lien on the property was substantial. And so what that means is when she wants to refinance her property, that lien has to be paid off. And so what that was the genesis for me saying, I now get it. I understand why wealth, one of the principles of wealth is insurance. It's about protecting what you have. So you don't go 2 steps forward and 3 steps backwards. It's about protecting yourself. Now, there is protection and there is investment. So today we're going to get the party started with investment. However, Jay is going to be back on another Saturday broadcast this month to talk about protecting your properties, protecting those items that need protection. Right now, we're going to have you beam in, whichever, on what kind of investment tools you can utilize with insurance. So, Jay, why don't you get us started and talk to us about what kind of products would a person want to be taking a look at that are protective process for their assets, but yet create some levels of wealth? The floor is yours.
Absolutely, absolutely. Thank you, Brent. And I'm glad you actually touched on those points too, because it is important for people to make sure that they are covered for the things that they have and for their assets. Because, like you said, you're not going to be able to build wealth if you owe somebody $100,000 because you got in an accident and you weren't covered properly. So
True that.
It's a very, very important thing to bring up. But yeah, so just to take a step back for a minute, there's a couple. I want to break life insurance into two main types, because most people probably think of the first type of life insurance when we talk about life insurance, and that's term. And that's something that's not building a cash value, and that's something that's there basically to cover an asset or to cover some debts or to cover your mortgage or something like that. But what I want to focus in on is the second type of life insurance, which is permanent insurance, which builds a cash value, which is going to allow you to do some actually very cool things, especially depending on what age you are. You know, things like saving for college. And I can actually tell you some of the benefits of using a whole life product versus a 529 plan to save for your children's college, which is a very interesting thing, and it's becoming more and more popular nowadays as more and more people are going to college. So that's really what I want to focus in on today, are those wealth transfer products and wealth building products. Because a lot of people...
Jay, hold on for just a second. Roll back for me. You said something about permanent. Would we call that insurance product a permanent product? If I came into your office and sat down with you and said, I'm interested in some permanent products, would that be what I would say to you?
Yeah, because there's a lot of different products out there, but it really breaks down into either term or permanent. And then branching off from permanent insurance, you know, there's permanent insurance that builds a cash value, and permanent insurance that's just going to cover you with a death benefit amount for your whole life. You know, it's going to be there forever. So up until age 121, you know, sometime most people die within that age bracket. You know, I think there's maybe one or two people that have outlived that in the history of the world. But yeah, so if you talk about permanent insurance and then you focus in more specifically permanent insurance that's going to build a cash value, every insurance agent that's selling life insurance is going to know what you're talking about with that.
Okay.
Yep.
So I was just commenting.
Okay, perfect. Yeah, and that's really what you want to focus in on, because it's really remarkable when you sit back and look at some of these products. And I always like to break it down for my clients, showing them how much you're actually paying in there for a premium and how much it's growing cash value wise, which it's different for everybody depending on your age and what health category you fall into, because that's going to affect how much you're paying in for premium. But for the most part, the younger you are, you know, the better deal you're going to get. So you're never going to be younger than you are today. So if you don't have these products in place, you know, that this is something to start looking at immediately, regardless of your age, because you're still younger today than you're going to be tomorrow.
I like that. That was well said. Okay, I feel better already. I'm not quite as old as I thought I was. Okay, keep going.
Absolutely. So let me just take a look at what I had written down that I wanted to make sure I covered. So yeah, one of the big things that I hear a lot from people, especially some people that might be retired or ready to retire, is I don't have any debts, you know, I don't need life insurance, I don't need any type of insurance. But if you've already got assets accumulated, or you've got wealth accumulated, and you've got these trusts set up, and you've got an estate created, you know, that's the most important time to start looking at some life insurance products, because you got to realize that someday when you pass away, or you want to transfer some of this money to your next of kin or to your beneficiaries, you've got to realize that if that's in an estate, that's going to be taxed, and that's going to be taxed significantly. Estate taxes are very high, 40 to 50%, you know, on your money. It's crazy. So you're giving up a lot of wealth that you've worked your whole life to accumulate, that you're kind of cheating your beneficiaries and your loved ones and your family members out of. You know, wealth building is not a solo exercise. You know, you're working together with your family, with your spouse, your significant other, your children, you know, to better everybody's future. And if you're not taking care of the assets you've already created to make sure that those are protected from tax implications, you can lose a lot of that money that you've earned. So the great thing about life insurance is it's not taxed. You know, the death benefit's not taxed. So if you have $1 million life insurance policy, that's going to pay out $1 million. If you've got $100,000 sitting,
Whoa. Just a second here. Let me understand correctly. If I have $1 million life policy that when at my demise, that actually pays out to my beneficiary, they have no tax on that?
Exactly.
Did I understand that correctly?
Exactly.
Wow. Okay.
So
Keep it going. Keep it going.
And then, so say for example, you have $100,000 sitting in a bank account somewhere. If you don't put that into some sort of vehicle that's going to protect that from taxes, like we said, that's going to be taxed significantly. You know, you're going to lose $40,000 to $50,000 on that before your family even sees that. Whereas if you bought a single premium life product with $100,000, you'd probably turn it into $150,000, $170,000 even, and that would go tax free to your next of kin. So I mean, that's how you create estates, and that's how you create wealth for your future family members too. You know, you've got to be thinking about everything, not just the short term, but the long term as well.
Excellent. Folks, did anybody catch a nugget when Jay was speaking? If you caught a nugget, then this is what I want you to do. I want you to go up on the exclusive Elusive Wealth Warriors Facebook page, and I want you to hashtag nugget and tell us what the nugget is. That's right. Let's get the fingers going, because this is interactive. When you communicate with us through the fingers, we know what's happening and what we need to focus in on. But that was a serious nugget. And if you didn't catch it, then we're going to repeat it so you can catch the wave. And while you're up there, go ahead and introduce yourself. Let us know who you are, where you're in from, where you're viewing this from, and what you do. Because, you know, when you let us know what you do, there are folks that may need what you have. You might be selling a product, you might be selling a service, you might have a venture that you want to share with us. And the only way that we're going to know about that is if you put it in the feed. So go ahead and put it in the feed. Also, why not let folks know that we're broadcasting right now? And this is the kind of information that they want to hear about, because we are about the business not only of changing our lives, but changing somebody else's lives. So go ahead and put that in there. Go on up and let folks know. Invite them into the broadcast. That's how we grow. You know, this is one thing we said, that we want to have 100,000 families around the world that have wealth. And the only way they're going to have it is if we help them out. So go on up there, get the fingers working, and we'll come back to you. Let Jay continue on. Jay, hit us again with what I thought was an interesting nugget, and that was the fact that the life insurance product has the ability to work for us tax-free, if you will. Did I get that right?
Yeah, absolutely, absolutely. So there's actually a couple things here to keep in mind. So first of all, you're putting money into a life insurance product that you know is going to pay out more than you put in. You know, so you're putting in 100,000. You know, you're guaranteed that 100,000, and it's going to pay out even more than that. Whereas if you didn't put it into a life insurance vehicle or I mean, life insurance is really the only vehicle I know of that you're going to not have tax-free death benefit. You know, you're going to put this money in and it's going to grow and be tax-free to your spouse, your kids, whoever you put as your beneficiary. You know, that's huge, especially with estate taxes being as high as they are. You know, it's almost polar opposites of what you could do with your money. You could leave it in an estate, have it taxed, have to go through all these crazy legal proceedings sometimes if you don't have a will made out, which is another thing. You should absolutely have a will made out, no matter what age you are. But just going back to that, yeah, you need to think about the tax implications, because it might not affect you once you're gone, but it's going to affect the people that you leave behind.
Understood. What other products should we be? Well, you know what? Before we talk about products, if a person, I'm looking for minimums that a person can work with and you utilize investment tools. You mentioned the word annuity. What other products? We've got life insurance. We understand that, and we need to understand permanent life insurance. What other products would you be talking to a person about? And without getting into too much of an age range, what would you talk to them about?
Yeah, so I mean, like you said, annuities are a great product, especially for people that want to do a safe investment. You know, they don't want to take a lot of risk on with their money. They don't want to lose their principal.
What is an annuity? Help our audience understand what is an annuity.
Okay, perfect. So an annuity, it can actually work a couple different ways. We have annuity products that you pay in monthly, or you can set up something to pay in one premium. And then basically how an annuity works is it's going to grow your money tax deferred on a tax deferred basis until you reach a certain age. And then it's going to allow you to make sure that you're receiving an income up to whatever age you want to receive. So, I mean, I might have kind of fumbled my words with that a little bit, but what you want to think of, it's almost like the opposite of life insurance. Annuity is going to pay you out while you're living. So say you get an annuity account and it gets worth $150,000, $200,000, and then you want to annuitize that once you're 65 years old. You can annuitize that to pay you out. You could say, okay, I want to have $500 a month for the rest of my life. And when you're setting up this account, you know, in the first place, with that in mind, you're going to be able to find a premium that you can pay in each month until a certain age, and then you can annuitize that, and it's going to pay you out more than you put in. You know, it grows your money on a tax deferred basis, which is very powerful with compounding interest and not having to pay taxes on it each year as well. So there's all sorts of annuities. You know, people probably the most common one people think of are IRAs and things like that. But there are a lot of products out there. Too many to really get into detail right now. But the main things to remember is you could have a single premium annuity where if you're basically ready to retire and you want to have a fixed income for the rest of your life, you want to know that you've got some sort of money coming in, you can take a large sum of money and annuitize that so it pays you out. You know, a lot of people, when they win the lottery, they choose to annuitize those earnings or those winnings because that'll pay them out periodically, and they make sure that they don't blow right through the cash. You know, so that's people use annuities for all different reasons. Maybe if they want.
I'm glad you brought that up. Okay, folks, be it known, this is a disclaimer. The Wealth Warriors did not say go out and join the lottery or go out and put money into the lottery so that you can have money to retire on. No,
absolutely not. No, I actually, honestly, I don't understand the big fixation with the lottery. I think it's a lot of smoke and mirrors, and I think if you're gonna gamble on something, you know, gamble on yourself. Put the money in on yourself. Put it into your own business, because you have a lot more control over that than you do over a scratch ticket or over the lottery or anything like that. You know.
I totally agreed. I totally agree with that. So somebody could put into the feed hashtag annuities are our friends. How about that? Hashtag annuities are our friends, because in fact they are. Jay, I've heard annuity. I've also heard something called a variable annuity. What is a variable annuity? Or do they still exist?
What's that?
I said, do they still exist?
Yeah. So variable annuities are tied to a variable market. You know, so it's a little more of, you know, it's not, I don't want to say risky, but you know, you're playing with an indexed product at that point. So there's definitely more room for reward there. There's definitely more room for growth, and it's still pretty secure. You know, you're not gambling on penny stocks or anything like that. You know, it's something that if you want to see more growth with your money and don't want to play as conservative of an investment, variable annuity is a great product.
Okay, so what we do know about annuities, we know a fixed annuity product is it's safe. You know exactly what you're going to have in terms of interest on your money. So it's a safe product. And then you have a variable. Can you have both? Can you have a fixed and a variable? Can you have two?
Yeah, yeah, absolutely. You can diversify your money. You can branch out into different things, and I think people should probably have some different products out there. You should have some life insurance in place to make sure that if anything happened to you, that's covered. You should have annuities in place, as long as you're not stretching yourself too thin either. You should always make sure that you can afford to pay for these things too. But, you should definitely be thinking about the long term and the short term at the same time. And that's really what you can do by mixing life insurance and annuity products and all these other fixed and variable products as well.
Well, hit us up with what are some of the other fixed and variable products? Because before you share that with us, what I want us to understand is we are layering. When you're at that place called wealth, and wealth, by the way, begins up here. We're actually going to have a speaker come in that's going to talk about the wealth in our head, because that conversation is what builds. So the wealth in our head then manifests itself when we're sitting down and we're having a conversation with somebody like a Jay Small. So what I'm saying to us is that wealth is layered. When we look at our whole totality, our whole picture, we're going to at least have 12 layers there. So one of those layers is very definitely a layer about insurance. So we talked about real estate. So real estate's going to be in there. We're going to have access to credit and lines of credit. That's going to be in there. We're going to have wealth products by way of insurance. So that's going to be in there. So Jay, what other products are we able to invest in? And I know there's a plethora, but give us a few to get us started.
Yeah, so there's a plethora, but what I would say a good starting point is I bet you most people, or the majority of people, have probably never even sat down and talked to their insurance agent about annuities, because they may not have even realized that they offered annuities there. So I would say the first step is to have this conversation with your agent and have them set up a personalized plan for you, because you can sit down and talk about what your goals are and what you want to do and how much money you have to actually put towards something like this, and develop a real strong plan. Because I know with Liberty Mutual, we have all types of annuities. We have certain ones where if you're looking to tie your money up for a longer period of time, there's certain bonuses that you can get for interest rate bonuses, extra points, so you could have an annuity with a 5 or 6% guaranteed rate of return on there if you're willing to tie it up for 5 or 6 years, which compared to leaving your money in a CD or something like that, it's night and day. You're getting 6 times the rate of return you get through a traditional banking product or something like that. So it's really important to figure out how much money you have to put towards something like this, because you never want to be strapping yourself for cash. You don't want to be tying up all your money and then you realize that you don't have anything in case an emergency comes up or something like that. You always want to be prepared for whatever may happen.
Jay, is there any insurance product that runs at the rate or similar to the rate of the stock market? Is there any such thing as a product that runs fairly closely in terms of interest building?
Yeah, absolutely, absolutely. There really are. With Liberty Mutual, we don't offer a ton of those because we don't get into the stock market too much. I don't have my securities licenses, so I don't want to talk too much about the stock market or things like that. But there are products out there like that, and if that's something that you're interested in, you can definitely find those. Annuities are a powerful tool, and they're very diverse. So that's what I would say about that is if that's something you're interested in, is having something that kind of works like a mutual fund or works like the stock market. Definitely talk to somebody about that. Find somebody who's licensed in the stock market, in the securities vessels and vehicles, and talk to them about that, because they are out there and they do exist.
Okay. You talked about and I appreciate that. And I appreciate the fact that you said, listen, I'm not this, so find that. So that's a good one. I appreciate that.
Yeah.
What I would also say is, when it comes to that plan, is there a charge associated with the plan? So that if a person wants to sit down and say, I'd like to draft that out, is there a charge that's associated with that?
So I can't speak with everybody for everybody, but I know with me personally, with our company, if you want to sit down and talk about planning your financial future and planning where you want to put your money. There's no charge for that at all. That's part of our job, is to advise people and to become trusted advisors for our clients, because we're not just an auto insurance company. We're not just a home insurance company. We're not just a life insurance company. No, we're a company for people. We want to help you and help your future. So we have no charges with that. Most companies that I know of that I work with don't have charges just to sit down and kind of start planning something like that. Obviously, if you're going to talk to a financial planner, I know that financial planners will meet with you for an introductory meeting for free and everything, and give you their advice. And then once you start doing certain things, then they might have a certain fee associated with that. But just to sit down and discuss these things and ask these questions, very rarely are you going to be charged for that. People are out there to answer your questions. People are out there to make sure that you understand what's available to you.
Absolutely. I appreciate that. And Wealth Warriors, that's in part why we are here, so that you get, not only do you get information, but you know the questions to ask. And in fact, you always know that Brent Harding is here for you, and that I do consultations. If you would like to have a short consultation so that we can lay out and put you in the right direction, then by all means, I want you to take down this phone number and actually put it in the feed. It's area code 617-438-7949. Again, that's 617-438-7949. Also, you can email me at Brent Harding. I thought that was original. How about that? Brent Harding, 617@gmail.com. If you would like to then have questions that I can then redirect over to Jay, I'd be more than glad to do that. We are fastly building a Wealth Warrior faculty of incredible individuals who are about the business of helping all of you. We're putting them together. There will be products that you will be able to obtain for your arsenal so that you can build. There are those consultations, and the consultations are for you to get a feel about those individuals. And then there are going to be service fees. So please know this, everything that is free, just because it's free does not mean that it is either good or bad. But I do know this, that there are times when you do have to pay for things. Let's face it, all of us utilized, we got our educations, we had to pay for those. I just want you to bear that in mind. We do generally have introductories so that we get to know each other, and then we go into the professional services. And I hope that's okay with you. So with that being said, guess what time it is? It is time for a flash mob. That's right. Get the fingers ready. We are about to go up in Twitterify. We are going to go up on Twitter. And what we're going to do is we're going to let folks know we are on the Wealth Warrior broadcast, and that we're talking about how insurance can be sexy. You know why it's sexy? Because we're talking about how you can make money with insurance. And more often than not, people thinking, oh, I got a car note, I got life insurance. Now we're talking about things that make money. We're talking about fixed annuities. We're talking about variable annuities. We know that there are other products out there that are pacing with the stock market. So we know that there are percentages that are run from 5% to 12%. Believe it or not, when you compound that, that makes money. And that's one of the layers. Real estate, access to credit, insurance. We are on a roll, ladies and gentlemen, on a roll. So, are you ready? Have you opened up your Twitter account so that you can Twitterify? Because that's where we're going. And we want folks to know that we're here, and invite them. In fact, use the icon that's above my picture and let folks know that you're here. So on the count of 5, we're going to do a flash mob. Are you ready? 5, 4, 3, 2, 1, flash mob. Now I hope everybody went up and they flashed. That's right, you flash mobbed us, and let folks know that we're here, because our mission is 100,000, and you are one of the precious 100,000. With that being said, Jay, I'm going to get back to you. Talk to us a little bit more about what you had in mind, some other areas that we can be looking at relative to insurance and the fact that we want to invest in insurance. What else have you got for us?
Absolutely, absolutely. And first of all, just to go back, if anybody has any questions for me, feel free to add me on Facebook. Feel free to send me some messages or whatever. I'm here to answer any questions too. After the show, whenever whenever you come up with a question, I'm in the process of starting a blog too, which hopefully by the next time I'm on the show, we'll have some posts on there and we'll have that up and running so you can follow the blog as well. I'm just working out some compliance things right now. But we should be good to go over the next week or so with that. So I'm looking forward to that too. So definitely stay in touch, connect with me. Life's all about building relationships and finding people because you never know when they'll help you out down the road. And I'd like to be there for you as a resource. But going back to kind of one thing I wanted to make sure I touched on today that I thought was something really cool when I first learned about this was the college saving aspect to life insurance for any people that may have maybe newly married and planning on having a kid, or you just had children, or you've got young children. This is an important thing to think about because a lot of people, their mindset is, let's get a 529 plan, let's get a college saver plan, and a lot of banks will kind of push you towards that way too. But in the world that we live in today, that's not necessarily the best way to do it. And I'd say it's not the best way to do it because I can tell you there are advantages to using a whole life permanent cash value life insurance product to save for college instead. So, for example, you have a newborn child. The best thing you can do is purchase a life insurance policy on the newborn child. Because it's going to be very, very inexpensive. We can write life insurance on anybody from less than a year old up to whatever age. But so it's really, age doesn't matter with this, but it's going to be very, very inexpensive if you have a young child to start a permanent product. And you can, another thing to talk about too. I don't mean to jump all over the place, but with these permanent products, you can choose when you want to pay up till. So you could do a 20-year. Where you're only paying premiums in for 20 years, or you could have it paid off by the time you're 65, or however you want to do it. So it's very flexible, and it's really customizable to what works for you. But just going back to that, so you have a newborn child, you could do a paid up in 20 life insurance policy where that policy is going to be paid off. You're going to be done paying premiums in 20 years. Now, if you have, say, $100,000 or a $200,000 life insurance policy, they get to be 18, 19 years old. They're looking into colleges. You can surrender that policy, or you can take a loan from that policy to finance their college, as opposed to a 529 plan. And some of the differences between those two, 529 plans are great, but they can only be used directly for educational expenses. Otherwise, there's a significant penalty. There's taxes if you don't use them for specifically for school. So when you look at college is a broad thing. You might be looking to buy a new car for your son or daughter when they go to school. You might be looking to make sure they have enough money for meals and things like that, maybe renting an apartment, things like that. So those would not be covered under a 529 plan, things like that. Those aren't directly tied to tuition or books. So you're going to be seeing penalties and you're going to be taxed on that. Life insurance, you can use life insurance proceeds or a loan from a life insurance policy to pay for anything. Even so, what happens if you get a 529 plan and you pay into that for 20 years and then your son or daughter decides they don't want to go to college, they have a different path chosen? You're going to be penalized for that. With life insurance, you can make that decision. And
let me tell you something. If I'm putting money in for a policy and they don't go to college, I'll kill them myself. Okay.
But I mean, that's the risk you run because we're in a changing world, and with all of the people in student loan debt nowadays, who knows 20 years from now what the college situation is going to look like. I feel like we're on a bell curve where back 30 years ago, not everybody went to college, and people joined the workforce, people figured out their own paths, and people, especially small business owners and entrepreneurs back then, you'd go out and you just start your own business. You'd learn a trade and start a business. Nowadays, we're kind of in this push system where your next step from high school, people tell you go to college, and that's what most people do. And there's plenty of people that are in college for 2 or 3 years before they even know what they want to do, and then they might even realize they don't want to be in college, so they've paid for 3 years of nothing, which is a scary thought when it's $50,000, $60,000 a year to go to school. If you're taking out the majority of loans for that, it's scary, and you're putting yourself in a bad situation. So I think it's important to leave yourself the freedom to be able to make these decisions, to be able to choose when you get 18 years from now whether or not your son or daughter belongs in college. Maybe they have an aptitude for music or something like that, and they want to go out and start playing music with people. So whatever it is, it's hard to predict the future like that, especially in the times that we live in today, where things are changing faster than they've ever changed. So I think leaving that option open is very important.
Absolutely. Absolutely.
Yeah.
Please continue on. What other products or items are you thinking about? Before you do that, I do want to share, Jay brought up a very good point relative to college. Also, I'm going to say something relative to the job market. Relative to college, I remember seeing an expose in which a young lady, doctor, came out of college with $300,000 worth of student loan debt. Now, can you imagine her and a gentleman coming together, getting married, and walking into their life with $500,000 worth of debt? That is insanity at its height. And so there need to be offsets. And that moved me tremendously when I heard this. I thought that was there was no other such insanity as that kind of situation. With respect to the job market, the statistics right now are saying that the average person, the average millennium or somebody in their 20s, somebody coming directly out of college, the average is they will work at a job 1.9 years, and then they'll go to another job. So 40 years, they will have worked 20 jobs. And that is insanity in and of itself. That's why for the month of July, we're going to be talking about entrepreneurship. We're going to be talking about safety nets. Billionaire, not millionaire, Warren Buffett talked about the fact that we need to invest in a second source of income. Well, insurance can be a second source of income. While you're working your daytime gig, that can be a second source. Entrepreneurship can be a second source or a third source. Again, layering. And therefore, we have a broad band. You know what I always share that my grandmother said? It's a poor rat that only has one hole. With that being said, Jay, let me bring it back to you. Share a couple of other products or thoughts that you have regarding how insurance can be a sexy investment.
Yeah, absolutely, absolutely. So I agree with you 100%. You never want to put all your eggs in one basket. You're asking for trouble with that. So it's important to branch out to different things. I mentioned briefly taking a loan from a life insurance policy. I think that's an important topic to get back to, because if you have a cash value built up in your permanent life insurance policy, after 5 years, you can take a loan from that, and it's at a 0% interest rate. You're not penalized for that loan. You can take the money out of there, and you're not required to really ever even pay it back, So of course it comes out of the death benefit. So if you have a $100,000 policy and you take 50,000 out of that, your family's only going to be left with 50,000 afterwards. But there's really no penalties for you for doing that. You're not going to have an interest rate to pay because it's earning a 3% interest and it's charged back around a 3% interest. So you're at zero with that. So that's an important thing too. Instead of going to the bank or maxing out your credit cards or doing something like that, you can use life insurance as a vehicle to finance something that may be slightly out of your reach. So that's an important thing to know too.
Jay, would you say that life insurance, we look at various levels of risk. So would you say that life insurance would be a very low risk item? So as you're layering and looking at what kind of interest is going to come into your household, would you consider that a conservative or a low risk item?
Absolutely, absolutely. Especially if we're talking about permanent insurance, you're basically talking no risk with a permanent product, because you're guaranteed the principal on that, and you're guaranteed the death benefit. If you're paying for a $100,000 policy, that someday somebody is going to get paid out that $100,000. So you may pay $25,000, $30,000 in premium into this policy, but you know it's going to be paying out $100,000. So
Okay.
that's it's a huge rate of return on that. And then with a term product, you know, we haven't really talked about term, but that's the only time you're really risking losing your money. But the reason for a term product is to protect your assets and to protect your family. So if you have a 30-year mortgage for $200,000 and you buy a 30-year term policy for $200,000, you might live longer than those 30 years. The term policy disappears, all the premium that you paid into it. Some people will say it was wasted, but was it wasted? Because you had the security of knowing that if anything happened to you during those 30 years, that your family wasn't going to have to sell the house. So, I mean, there is a need for that too. So I don't think there's really any risk to a life insurance policy, you know, and everybody has a need of some sort, you know, whether you have a lot of money, like we talked about earlier with the wealth transfer need, or whether you have no money, then of course you need life insurance, because you're going to leave bills behind when you go away. You're going to leave burial expenses behind. You're going to leave debt and put your family further behind, which isn't a fair thing to do. So everybody, no matter what age you are, has some sort of need for life insurance.
Question, you mentioned wealth transfer. Define wealth transfer.
Yeah, what I mean by wealth transfer is so transferring from one generation to the next, or from one person to the next person. So from the person who's insured once he passes away or she passes away to their beneficiaries, you know, transferring their money, because obviously the goal is to earn as much money as you can in your lifetime and really set up a strong, solid financial future for yourself and your family. But if, like we were talking about, if that's just sitting in accounts and sitting in estates or whatever, and that gets, and you pass away, and that gets taxed, you're taking a large chunk out of your family's future, out of your family's security, out of your family's finances, which isn't fair, when you could, just by signing a piece of paper and kind of transferring where that money's going, you could actually increase that money. You could double it, you know, and leave something nice behind, leave more of an estate behind for your family without any of the tax implications. So I think that's a very, very important thing for any people that are getting ready to retire or are retired and are kind of enjoying the lighter stages of their life. You've got to be wary of where your money is and what's going to happen to that.
Agreed. What I want to share with us now, just for a moment, is this. When we have Jay back, we're going to be talking about ages and what kind of products we should have or would want to have at certain ages. So the 20-somethings, which I remember being 20 and being invincible. And we want to make sure that we're clear about that we understand that, guess what? There is insurance you want to have in your 20s, 30s, 40s, 50s, 60s, and beyond. So there are elements. Again, it's the building blocks, and we want to get that going. I am committed to you in that within this 12-month period, by April 2016, your life is going to monumentally change if you are willing to follow what we're doing. It will change. You will own real estate. You will have a strong credit profile. You will have insurance that meets the need and has investment value to it, so that you are doing it not just for the generations after you, but also so that we live a better lifestyle. Because in fact, it is about the lifestyle. You will have some level, more than likely, many of you will become entrepreneurs. Why? Because it allows, we're creating residual income for ourselves as well. Why? So that we're not dependent on any one thing. One of the sad elements about life is when you have to go to work when you're ill. And I've seen too many of us have to go to work when we're ill. Why? Because we are fearful of losing our jobs. Wouldn't life be grand if you had rental property, money coming in from that rental property? You had insurance. You knew that that next generation is covered, and there was a possibility of you being able to borrow from that. Wouldn't it be grand if you had residual income coming in from a business that is in such a manner that it produces residual income for you? So look at the layers already being developed. That's wealth. When you have layers, when you think about some of our wealthy celebrities or people of notoriety, they own different things. Now, admittedly, there are some folks that say, "Hey, I don't want the responsibility of owning." Okay, but think about this. How about the next generation? Because we want to be able to pass on the legacies. So that's part and parcel of what happens here is how do we pass on that legacy? How do we go to the next generation? So, Jay, we've talked a little bit about, we've talked about life insurance, not with depth, but we've talked about the fact that we need life insurance. We've talked about permanent, we've talked about term, we've talked about annuity as one of the vehicles. We've talked about fixed, or we've talked about variable. There are a plethora of products. What other things, as we're getting ready to wrap up in about 9 minutes, what other types of products that could generate income or generate interest and revenue? What else would we be talking about?
Yeah, so actually, you actually just reminded me of something that I forgot to mention that I wanted to talk about too today. When you were talking about people's businesses and entrepreneurs and things like that, if you're in a partnership or you're in a corporation where you have key people that are essential to that organization, you should have life insurance policies on those people because you've got to think if how detrimental that would be to your business if something happened and they passed away and you had to go try to find somebody to train and to replace them. You've got to have key person insurance. You've got to have these people insured because they're essential parts of your business. And I've seen companies and partnerships where if somebody passes away, then the business gets sold. Whereas what you want to do is have life insurance policies on each other. If you have a partnership, you should have life insurance policies on each other so that you can buy the company out if anything happens. You don't want to be you don't want to be caught up in litigation with somebody's widow or something like that, trying to figure this stuff out. You want to have the ability to just buy this out.
Understood. And folks, what that speaks to is planning. A lot of times the person that fails to plan plans to fail. And you can hear that when we're talking about succession insurance, where it's for who's going to succeed, who's going to carry on. And so again, we're talking about how do we plan that out? You've got people within our Wealth Warrior faculty that will give you some of their time so that you can have those kind of conversations and we can plan, we can lay out the goals. Goals are for everybody and goals are written down. It's like a business plan, it's written down. Like a sales and marketing performance plan, it's written down. And sometimes people say, "Oh, Brent, I don't have time." Make time. Make time to sit down with people like Jay and I, because our role is to help you advance. And when you advance, guess what? We advance as well. Would you agree, Jay?
Absolutely, absolutely. I think Zig Ziglar said it best. To get whatever you want, you got to help as many people get what they want first. And honestly, the goals are planning for your future, because if you don't know where you want to go, you're never going to get there. That's very simple.
There used to be a statement that said, "Any road will get you there." I like what you said. No, you're just not going to get there.
Yeah, you'll never get there. If I take off from Logan Airport and we don't know where we're going, we can just fly around until we run out of fuel. You've got to have a destination in mind.
Oh my goodness, that is so true, and it brings back my air traffic controller days when we did have a person that was a student, and he was learning to fly, but he wasn't landing the plane. And at one point, the controller said, "Look, pal, it goes like this. You're coming down one way or another. Which would you like? Follow the instructions, and we'll land the plane." And so when you said that, it definitely brought that back. Any road will get you there, but will you get to where you want to go to?
Absolutely.
That's pivotal. That's pivotal. Folks, we've covered a plethora today of information. This is the beginning of Insurance Month. Insurance has a sexy tone to it when we are making money. And wealth is about creating it and sustaining it. And we have vehicles that make that happen. Jay, is there anything special that you have going on that you would want our listening and our viewing audience to know about?
So like I said, I'm in the process of starting up a blog right now. I'm going to have that information for you next time. I'll post it in the group as soon as, it's basically, I'm just focused on the domain name right now. We might have some compliance things to tweak around. But as soon as I get that domain up and running, I'm going to post that in the group, and I'll be sharing that everywhere. So definitely follow that, stay up to date with everything. Connect with me on Facebook, connect with me on LinkedIn. Just connect with me, you know, so I can answer all your questions. That's what I'm here for, is to be a resource for you.
Excellent, excellent. And you've been at this for how long? You've been in the banking industry. Background is how long were you in the banking industry?
I was in the banking and financial services industry for 5.5 years, and I've been doing insurance now for a little over a year and a half with Liberty Mutual.
Congratulations, congratulations. Appreciate that very, very much. Folks, we're going to be wrapping up in 4 minutes. Here's a few things for us to know. Next week, we will be back with another element of insurance. That's one. Secondly, for the remainder of the month, we're going to be talking about insurance packages. We're going to be introducing you to professionals. Certainly, Jay will be in that rotation. For the month of July, we're going to be focusing in on entrepreneurship. And then we're going to follow that up with the legals. You heard Jay mention something, I think, about trust. We're going to be learning about trust and family trust. We're going to learn about nominee trust, realty trust, various elements that are powerful. And again, it's not just one item, it's the succession of those items that will create the wealth. By April of 2016, we expect to have we want to do a scan of people around the world that are creating wealth for themselves and for the next generation. And we expect that it's going to be pretty daggone powerful. We appreciate the fact that you tweeted out and you let folks know what's going on. Next week, we're also going to have a book that we're going to be offering that you will be able to purchase. And that book is about leveraging your money, leveraging the things that you do to create wealth, and it will be awesome. I hope that what you're saying to me is that you got some incredible nuggets from today's shows, and that as a first generation wealth baby, that you are really serious about creating wealth for your families. Jay, do you have any last minute statements or last minute that you want to share with us before we wrap it up?
I just want to say thank you to everybody for tuning in today. Thank you, Brent, for having me on the show. I really appreciate it. And if you have any other questions, you know, send me a message through Facebook or send me an email, jay.small@libertymutual.com, and I'll get back to all your questions.
Jay, I appreciate that tremendously. Thank you so much. On behalf of the Wealth Warriors, I want to say that my name is Brent Harding. I'm the founder of the Wealth Commitment, and we produce Wealth Warriors. We will be back here next Saturday morning at 9 a.m. with another segment of insurance. As Trevor Ott says, go out and be amazing. And we will see you the next time. Bye-bye now.
Thanks.
You're welcome.